Hello everybody, this is Eddie Ghabour, owner of Key Advisors Group. Please subscribe to our YouTube channel for up-to-date videos on market moves that we have been making for clients, but more importantly, in my opinion, educational videos that hopefully can help you and your family get to where you want to be in this ever-changing market and economy. So we've been warning our clients since the fourth quarter of last year that second quarter 2022 was the one that we were most concerned with. And now that dreaded second quarter is getting closer and closer with each day. And I want to talk about why we've actually got an even stronger conviction that the second quarter could potentially be, problematic from an economic perspective and then potentially also from a stock market perspective. Obviously, nobody can predict tops or bottoms. So when we make these judgment calls, it's based on the data that we're looking at, knowing that we could be wrong. But hopefully, again, our job is to share the big picture with you and allow you to make the decision that you think is right for you and your family. So one of the biggest issues that we had coming in the second quarter that was our concern was the Federal Reserve tightening interest rates going into an economic slowdown. Traditionally speaking, when that happens, that kind of really puts the brakes economically, and as you know, that market doesn't like that. Well, now that we have the Russia-Ukraine war happening, the dynamic that we weren't counting on coming into this year was oil being above $100 a barrel. And so what that means for us is that's even more bearish from an economic standpoint because the consumer is going to get squeezed even more than we were originally concerned with. So if we go into this second quarter and consumer spending softens even faster than what we were anticipating, you could potentially see a GDP number that comes in well below consensus. And the Fed is in a really tough spot right now because the yield curve, which is the difference between the 2-year Treasury bond and the 10-year Treasury bond that we look at, has really compressed. And normally, you do not want to see an inversion. You don't want to see when the short-term bonds go higher than the long-term bonds. Many people say that's a prediction of a future recession. And so now we're at a point in time in history where I'm not so sure the Fed has ever tightened when the yield curve is this flat, nor have they tightened this late in an economic cycle. Again, in our opinion, it is crystal clear that things are slowing down. Our economy is based on consumer spending. That's a big chunk of our economy. And if inflation just is so hot that it kills or hurts consumer spending, naturally you have to expect the economy to really slow down. And the whole purpose of the Fed raising rates is to slow the economy down in a sense to try to tame inflation. So you have two dynamics that are working against the market. Now, of course, if the Fed were to announce today that they're going to change course and now all of a sudden they're not going to do tightening, that would more than likely change our stance short term from a market perspective. However, at the end of the day, that's not going to solve the inflationary pressure. So we're at a point in time in history that may go down in the record books. I mean, unfortunately, the higher gas prices could not have come at a worse time from an economic cycle and from a consumer perspective. And then when you add the Federal Reserve tightening into that, this is why we've been so bearish on the markets and have really been playing defense. And I know I sound like a broken record, but we are not going to change our stance with our clients until those fundamentals I just shared with you change. And I don't know when that's going to happen. You don't know when that's going to happen. So we have to take this day by day. But there are times when it's okay to be cautious, in my opinion. It's okay to be bearish, in my opinion. I just think you have to make sure that you know where to pivot to and the timing and incremental changes that you make. The number one job, in my opinion, that we have is trying to risk manage client assets in a way that we can manage volatility. Investors usually aren't going to be comfortable seeing 30% swings in their portfolio. Now, if you're a high risk taker, that's a completely different story. But at the end of the day, we have been playing defense since the fourth quarter. We continue to play defense and actually increase our defensive positions because we are extremely concerned with this perfect storm of negative economic data that could hit us all at one time. Now, look, I have a lot of faith in this country. We're still the best place to live. We will get through this. but it's just a normal economic cycle. You're going to have recessions every few years. You're going to have stock market corrections. And again, if you're a long-term investor, it shouldn't be as big of a concern in my opinion. But if you're someone that likes to be taking advantage of short-term tactical changes, then our defensive position would have served you well. However, this video, again, is just to give you information on the dynamics that we've seen unfolding and why we've been so concerned about the second quarter. And it's going to be very interesting as this economic data starts to come out at the end of March and April and May to see how the markets react to it. So that's it for today. I hope you got a lot of value out of today's video, and I wish you the best of luck and make it a winning week. Thank you.